here. Thanks so much, Ganesh, for giving me this wonderful opportunity. Um, it's always really great and exciting to work with the Covalent team. So as Ganesh said, yes, this week the second phase of the data competition is for Curve Finance, which is the leading DeFi stablecoin and also Bitcoin on Ethereum AMM. So I'm happy to walk through some of the CSVs that Ganesh and the Covalent team are providing. We can also walk through some of the challenge questions to explain how you all might approach them and go through some potential strategies, and also just clear up any potential things that might not be immediately known or clear. So yeah, Ganesh, what do you want to start with?
Maybe let's start with roughly the participants in the Curve ecosystem. You have the traders, and you have like roughly how each person is incentivized, and then you can screen share the challenges, and then just walk over a couple of challenges, and then possibly open up one of the CSVs.
Of course. So as I said, Curve is a leading stablecoin and Bitcoin on Ethereum AMM. You have various different participants in the Curve ecosystem. Curve is actually one of the leaders, so they do billions of dollars in volume per day, per week, I guess. And so you have liquidity providers, people, traders, investors, other parties who stake stable coins or Bitcoin on Ethereum. So TBTC, wrap BTC, synthetic BTC. That's Bitcoin. Then there's all kinds of stable coins. So you can stake in certain pools that Curve has, and that provides liquidity for traders who are coming in that want to exchange maybe one form of a US dollar-backed stablecoin for another form of US dollar-backed stablecoin. And you can do this on other platforms as well, but Curve has a specific Curve, as I guess the name is fitting. As opposed to other AMMs, which are constant function AMMs, so that's like Uniswap, x times y equals a constant. This is getting a little bit in the weeds, but it's important because Curve is a very different function. It's actually constant sum, so x plus y equals k. This actually allows for reduced slippage on pairs that are relatively the same price, so it makes Curve a better option for stablecoin trading or for trading between different forms of Bitcoin, as opposed to something that has a constant function like Uniswap or Bancor, for example. So Curve has been in the game for a while, and they've been doing a lot of volume. But only recently, also, they introduced the Curve DAO, which is a decentralized autonomous organization, which also has a coin, a token, to govern that DAO. The token has been issued through emissions to liquidity providers over the past month or two, I guess, and so these emissions have been constant, and they will keep going for years. And importantly, for our purposes here, because one of the challenges actually touches on this, the way these Curve tokens are distributed are to the various different pools on Curve, but these pools are set by the Curve DAO token holders every single week. They vote on the distribution to specific pools. And so one of our challenge questions that we're going to talk about actually touches on this and asks and gets a little bit deeper into how these tokens are distributed. I hopefully that provides somewhat of an overview of the Curve ecosystem, what makes it special and different, and also provides some of the background for these challenges.
I have a question. So Ben, from my understanding, it's a stablecoin exchange. So USDT, DAI, USDC, TUSDC, and so on. How does Bitcoin come into the picture here?
Of course, yeah, it's a great question. So Curve is primarily an exchange for stablecoins because they're stable in value. So you want to go from something that's about worth $1 to something that's also about worth $1. The reason why Bitcoin comes into the equation here is that there's a lot of Bitcoin on Ethereum in the form of wrap Bitcoin, wrap BTC, Ren BTC, synthetic BTC, and then most recently TBTC, which is through the Keep network. And the reason why Curve works well for Bitcoin, or theoretically works well for Bitcoin, is that similar to something that's pegged to $1, going from one form of wrap Bitcoin on Ethereum to another form of Bitcoin on Ethereum will make sense because the prices should basically be about the same. They should be worth about the same, which is one Bitcoin. It doesn't make sense to go from one Bitcoin to however many Ether on Curve, because that's not how the underlying function of the Curve pool works. But if there were, for example, 5 different versions of another coin on Ethereum, Curve could also create a pool for that, as long as those those tokens were used enough that the price has generally stayed basically stable. So it doesn't have to be just USD. Bitcoin is basically the second use case for the Curve network, and theoretically, as if there are other wrapped tokens in the future, those can also come on Curve if there's 4, 5, 6, whatever there are. I don't know if that answers your question, but hopefully it does.
Thank you for that explanation. Makes sense.
Of course. Okay, so Ganesh, do you think we should dive into the challenges themselves, or do you want to go straight to the data sets?
Let's walk through the challenges. Just there are 4 of those, I think.
Okay, awesome. I'm just going to pull up and share my screen. Doing that right now. Share Chrome tab. Perfect. Okay. So this was just published today. Ganesh, can you see my screen? Can everyone else see my screen?
Yeah, looks good.
Okay, perfect. So this was just published very recently, and you can find it on the Covalent website. I'm gonna briefly walk through the challenges, and then we'll go through the data sets above. So we have different challenge levels as Covalent did last week for the Uniswap challenge. As you can see, they go to they ascend all the way to transcended. So there are 3 tasks this week, and we'll also just briefly review them in ascending order of difficulty. So the first is just to look at total volume traded, and this is something that is also found elsewhere in various trackers, but it's a good challenge, and it's an important challenge to be able to work with the different data sets that are provided above that we'll go through soon to essentially get an accurate picture of how much volume Curve actually trades on a daily basis, weekly basis, over a given time frame. And so, your task, there's discretion here in how you want to present the data and how and how to make this presented as in an intuitive way. But the challenge itself should be relatively straightforward. You're essentially trying to look at how much volume Curve has done over a specific time period. And Ganesh, what time period are we going to be looking for here?
I would say daily volumes make sense. So you can compare this with Coinbase because they publish daily volumes. Maybe weekly volumes make sense. But the data set is every single transaction in that pool from the beginning to, I believe, whatever that's blocked up or snapshotted.
Right. Yeah, that's helpful. And also one other hitch here. We just talked about how there's Bitcoin on Curve and how a lot of Curve's volume actually comes from. Not the majority of it, but a lot of it does come from Bitcoin transactions. So one thing you might want to keep in mind when you're looking at daily volume is to, if we're including the Bitcoin data sets, which I guess actually doesn't look like we are. So that's actually not something you have to be doing here. We're only going to be including DAI and the pool 3 and the Y pool. But just, I guess, for your own sort of thinking about it, if we were including the Bitcoin data sets for the Bitcoin pools, you would probably want to do is to weight the different volume per day by some sort of time weighted price as you add up the different volumes per day or per hour per however granular you're able to get. But that's I guess a little bit more difficult that you don't have to do here because there isn't Bitcoin volume. Moving to the second out of 3 tasks, this is an important one. This is calculating slippage rates. So slippage, just to give a brief overview, this might be basic, but it's important because this is a lot of what Curve's bread and butter is slippage or maybe price spreads is essentially how much it costs to go from X number of one coins to X number of an equivalent token that's actually a bad way of putting it, not equivalent token, but an analogous token. Essentially, how much do you lose trading from one token to another at various price sizes? So let's say maybe if you're going from USDC to USDT is 1-to-1, and maybe going from 100 USDC to USDT is 100 to 100. If you were to go from 10 million, it might not actually be 10 million USDT because there may not be enough USDT in the pool to accommodate a fully 10 million USDT for that USDC trade. So whatever you lose on the other side of that, maybe you only get 9,999,000, whatever it might be. So whatever you lose there is considered slippage. That sort of loss of whatever rate that you don't get because of the size of the trade. And this is important if you're a trader. Obviously, you want to minimize slippage. There's ways you can get around it by breaking up trades, but that's often that might take more time, or it also might take more gas if you're on Ethereum, and you might want to just push through trades. And so if you're doing that, you want to look for the lowest slippage possible. So as I said, Curve's bread and butter is trying to offer the lowest possible slippage rates, which they do through their formula and also through their liquidity that they've been able to attract. And so for this challenge, we want you to basically look at the various different trade sizes, and you can see the different trade sizes here, and to calculate slippage rates for these two pools, for the two data sets above, and to present a 1 to 2 page report on your findings. What are the slippage rates for the different trade sizes and for the different pairs, or just for the different pools, and you can interpret the data as you will. I think this is important because it's informative not only for people who are looking at Curve, but also just for traders in general. They might want to know what optimal trade size they should be splitting up their different orders into. If slippage on a 50,000 trade or above is significantly higher than slippage on a $5,000 trade, they might want to split up their trades into $5,000 trades, but maybe gas prices are too high to give them. So all these different variables come together, but this is a really important one, these slippage rates. So this is also getting a little bit more challenge because you have to break up these different trade sizes. You have to look from different pairs, and there might also be other nuances, including rates of one token to another. So USDC might not really be equal one USDC to one USDT. These are all things that I think have some discretion on here, because it's very difficult to establish what the fixed rate is for USDC to USDT. So as long as you're able to show potentially relative slippage compared to what they are at various different sizes, I think that would be potentially the best way to do this, unless Ganesh unless you have something else, some other direction here.
No, that's good.
Okay. I'm also happy to, if you have questions and you're working on this, you can shoot me an email. I'm happy to provide my email after this. But the last challenge, and I'm sure also Ganesh and the Covalent team can help. The last challenge has to do with the gauge rewards, so the liquidity mining rewards that started about a month or two ago, that we briefly spoke about before. As I said, the gauge rewards are set each week through a vote on the Curve DAO, through the Curve governance. The token holders are able to vote on which pools get what number of Curve tokens that are distributed each week. And so the challenge here is to essentially look at the historical Curve DAO gauge rewards. And so we haven't included this data set yet, but we will. It'll be just basically going back a month to the past 4 weeks of Curve rewards, and each week, of course, there's slightly different rewards to various different pools on Curve. And so what you'll want to do is to use those numbers in terms of the gauge rewards to basically figure out whether gauge rewards are actually matched up well with the volume and liquidity for each pool. So what I mean by that, just to give you, this is like kind of a difficult thing to conceptualize, and I'm not sure I explained it just now, but to maybe give you an example to potentially make this clearer. Let's say the gauge reward weight for the Y pool right now is 18.8%, which it is. But let's say, for example, that actually 20% of liquidity on Curve is in the Y pool. I'm not sure if that's the case. We can look. That might be an example of an inefficiency or an inconsistency in how the gauge rewards are allocated. Maybe, for example, some pools attract a lot of volume, but they actually have less rewards, and maybe they should have more rewards because there's more volume going to those pools. These are all things that this challenge will help shed light on, both, and it might also even potentially inform the way Curve governance happens and the way Curve token holders vote. I mean, there's obviously other interests involved there, but this is potentially an important and helpful task that can help inform that analysis. Hopefully that covers it. And note that the gauge rewards, the historical gauge rewards for the past 4 weeks are not out yet. They're not here, linked above, but they will be soon. Ganesh, does that cover?
That's great. Yeah, that's all.
Okay, awesome. Do you have anything to add before we jump into the data sets?
No, I think we're good. Oh, one question I have is, right now, how is the how the governance parameters set, who's coming up with these numbers, and how are they balancing liquidity and volume?
Yeah, so I'm not active on Curve governance in terms of setting rewards. So I'm not sure. I think if you look back on past governance posts, you'll see how it's done and how it's voted upon. But each week, I think a proposal is sent and it's voted on by people who hold voting Curve. I'm not sure exactly if the numbers come from the team and then they're voted on by the community, or if they're proposed by the community. I can look and get back to you on that. I think I also would just have to look through the past governance votes on this. But there's also been some interesting research done on this question specifically. I know Delphi Digital put out an interesting piece recently on Curve DAO rewards and Gauge and all the incentives there. So this challenge can hopefully add to that growing body of research.
Awesome, thank you.
Of course. So maybe we can move to a data set now. Okay, awesome. I'm going to share my screen again. And Ganesh, maybe you'll jump in here also, because this is really your area of expertise, not mine. But I'll I guess kick us off with the Y pool data. So if you can hopefully see my screen now, this is one of the two pools that Ganesh sent, or that the Covalent team sent on the website that we were just on before. It has two CSVs, and this is the Y pool CSV. So what Ganesh did was what Ganesh and the Covalent team, don't mean to leave out the rest of the team there, but what they did was they took essentially every single event for an underlying transaction that happened in this pool. Ganesh, do you want to elaborate on that a little bit?
Yeah, absolutely. So what happens with the smart contracts is that there's a smart contract per pool. So there's a contract for the Y pool, there's a contract for the 3 pool, there's a contract for the dozen or so different pools that's on Curve. And every time there is anything of interest happening with the pool, either adding liquidity, removing liquidity, or a token swap, there's an event log that's emitted. So in this particular case, what we've done is we've extracted every single token swap for the Y pool from the minute the contract was deployed onto the blockchain until, I believe, 11,240,000 block height. So that is basically what this is. And I can just quickly go over the first set of columns. So you have a block signed at, which is just a timestamp for the block was signed. The block height is just, I think it was deployed for 9.4 million. So that's what the minimum block height is. And then you have transaction offset. So within a single block, all of the transactions are ordered based on an offset. So they're sequential. So that's basically what it is. It's not super helpful for this data set, but just for completeness, if you want to look it up, you can look it up Etherscan by a particular block height, and then you can go down the list of transactions, and that is the offset. The log offset is these transactions emit lots of events. So it's not just the swap event, but it's also the transfer event. It's probably something else, an approval, or if Curve is wrapped into another higher level protocol, it emits events from those, like flash loans or whatever you want. And so the log offset is within the transaction, it's ordered by log events. The transaction hash is transaction hash. You can directly paste that onto Etherscan. Sender address, in this case, this is the Y pool that's always sending the log event. Sender address label, this is the label. So in this case, you know that the Curve Y pool, log buyer is who's buying it, sold ID, log tokens, log bot ID, log bot token spot. So those are the 4 columns. And so if you go back to the description, it does. Yeah, on the blog post.
I'm not sure if you can still see it. I'm going to just actually share my entire, let's just share the entire Google application window. There we go. Share. Okay. Can you see the website now?
Yeah.
Okay, awesome.
So in the case of pool 3, you have 3 underlying stablecoins, DAI, USDC, and USDT. And the token IDs are 0 for DAI, 1 for USDC, and 2 for USDT. So when you go back to the spreadsheet, when you see the token ID, that's what it means. So this is the Y pool. So obviously you have to look up the 0, 1, and 2 respective to the Y pool. But this is telling you exactly what the swap is. And a common misunderstanding here is how are those logged tokens formatted? And we never format in decimals because computers are very bad at representing floating point numbers. So what we do is we leave it in the number of contract decimals. So for example, if it's wrapped ether, the number of contract decimals is 18. DAI is 18. So what you need to do is you need to scale that log tokens ID by the number of contract decimals. And the way you scale that is you divide by 10 to the number of contract decimals. So here, if you take one of those numbers and divide by 10 to the 18, if the contract decimals is DAI, then that's the actual units that you see on Etherscan. The reason for doing that is we want analysts to be explicit in how they scale these numbers, because USDC and USDT, if I remember correctly, the contract decimals is 6. Wrapped Bitcoin, the contract decimals is 8. So if we scale on our side and you're trying to calculate ratios that all of the numbers mess up, it just introduces more errors. So this way, it's very explicit in what you're doing. And Ben here actually has a cool trick on how to figure this out. So which I learned from him. So
yeah, well, I think Ganesh has the real knowledge, and my trick was just to compensate for the fact that I wasn't exactly sure. I wanted to make sure I got the division right, but I wasn't exactly sure. I mean, I could have looked up the contracts themselves, but this was a little bit of a hack. I wanted to mention, though, briefly, Ganesh provided here the token IDs, as you can see, but I was curious because I actually wasn't sure exactly how to get those when I was looking at the data first, and so Ganesh showed me how to do it. What you want to do, for example, is you go to, let's say, the pool, so that's under sender address. This is the Y pool. We're going to go to, can you still see my screen?
Yeah.
Oh, wait, that's not, I don't know if that's right. Sender address, shouldn't it go to the?
That is right.
Oh, that is right, okay.
Yeah.
And we go to the contract, okay, perfect. And you go to the contract here, and you go to read contract, this is what Ganesh showed me, and you go to coins, and to get, for example, the ID, let's say we want to get the ID of 0, what you want to do, as Ganesh showed me, this is on Etherscan, is to query, and then it shows you, it gives you an address out, and then you look at this address, and we see, okay, it's iron DAI, so this is Y DAI, and that gives you the sense. Now the question here, though, is, okay, so as Ganesh said, how do we know how many decimals there is? Well, you can look, and you can look on the contract on Etherscan for that specific token, and you get the decimals. But let's say we didn't even know how many decimals there are, and this is sort of where we get the hack that Ganesh was talking about. Let's say let's go to this one down here, just this row. I'm going to highlight it. So it looks like we have logged sold ID and log tokens, this very massive number starting with 25497. So what I'm going to do is I'm going to create a new column. This is all in Google Sheets, but you could obviously do this anywhere else that you process CSVs, Python, Excel, whatever else. Or you can do this in SQL. But what I'm going to do here, and this is the hack, is I'm going to go to the transaction hash, which, of course, each transaction has a unique hash. I'm going to take that. I'm going to go back to Etherscan, paste it in. And I see here what the transaction was. So I see that there is 2,549 DAI. And now here, it looks like there's this massive number, but it starts with 2,549. And sure enough, it also has the 0.27. So what I'm going to do is I'm just going to, and this is, again, a little bit of a hack. It's not necessarily the cleanest thing to do. I'm just going to divide it by however long it takes to get to 2,549.27. That, I believe, is correct. Yeah, okay. And so that's that's 10 to, I guess it must be the 18th. That's what I'm dividing it by. But if I were gonna make this easier to do, what I might also do is now I'm gonna sort this column, sort it A to Z. Okay, so now I have zeros, which mean that all of these are sold. All the sold tokens here die. So what I can do here is, this is just like the Excel or the Google Sheets trick. I can just drag this down until I get to the end of the 0, and then I have to look and see what the 1 is and do the same process. And then of course you also would want to do this for the bot as well. But you can see, and just to double check this, there's 2549 or 2,549 die here. Let's check this as 64. We're just going to double check to make sure that that's correct for this transaction. Should be. Yep, 64.02. So that's there we go. One other thing I want to say, and so thanks first of all to Ganesh for helping walk me through how to get the ID numbers for the different tokens. But one other thing though is, it's possible, I'm not exactly positive, but it's possible that these transaction hashes, there are multiple different entries for each one, because as Ganesh said, what he queried was the underlying transaction, the exchange, but not per, there might be multiple exchanges per transaction hash if there's multiple different exchanges happening within one transaction. So the Y pool, I'm not sure exactly if that's the case for this data, but when I was looking at other curve data, it was the case that one transaction hash might have actually 4 different exchange events, because it's going from TUSD to USDC to USDT, whatever the most efficient routing is for that specific transaction. But that might show up as 3 different, I guess, rows, and if we're using Excel, but in reality, there's only one transaction hash. So if you're trying to aggregate this data somehow, you want to make sure you account for the fact that the transaction hashes might include multiple different exchange events.
But in that case, if there's a transfer one way and then transfer back, that actually is 2 separate swaps. So it'll add to the transaction volume.
Right, that's true. I guess what I was looking at before was it might have been also the first iteration of the Y pool data, which, I mean, we, as Ganesh, worked tirelessly to make sure we found the right data set. So it might have been like the wrong event calls, like the first version, not this version. But when I was looking, I think there were multiple different like events per transaction hash, even though there's only just one swap. But I guess, I mean, I think what you're saying is, it's going to go from the sender to the Y pool, and then from the Y pool back to the sender, which counts as 2. I think even with that, there might have been more, but I also could be wrong here. So that's, I think, one thing potentially to dig in, especially for that might make this more tricky. But that's also why these challenges are fun and important, because there are some nuances here that you might have to look into. And this is, I think, the main one. Everything else should be relatively straightforward as long as you've accounted for the decimals and the correct token IDs. Yeah, I mean that's all I really have on the data, unless Ganesh, there's other things to clarify here.
That's basically it.
Awesome. I'm gonna stop sharing. Okay. Yeah, I mean that's it for me.
Awesome, Ben. That was pretty incredible. I definitely learned a trick, one or more tricks from just your presentation. So now we'll open up the floor to questions from the audience, if there are any. So first question is, please walk me through it. What is up with the tables? What tables?
Are we talking about like the Google Sheets?
I guess this was before the event started. This was 31 minutes ago. So probably in AirMeet you have that social tables. You consider a table and then chat. I'm not sure. AirMeet is new to me. Okay, next question. Is the Uniswap dataset finally fixed and deadline is still tomorrow? So yes, the Uniswap dataset has been fixed. If you go back to the blog post, it has an updated timestamp there, and you can download the new datasets. And the deadline for the data science competition, the data parts have been extended. Definitely check Telegram for the latest update on that. So deadline expanded, deadline already attached. Any questions? Are we good here? Yeah, it was AirMeet tables. Okay, great. It's just overloaded. Is it database tables? Is it spreadsheet tables? Is it pivot tables? Is it AirMeet tables? Tables is an overloaded Okay, great. I think that was fantastic. See you guys next week. We'll have another exciting guest, and looking forward to what you guys come up with. And we're around on Telegram if there are any questions.
Thanks, guys, for listening. Thanks so much, Ganesh, for having me.
Yeah, no, excited. Thank you.